Hi everybody, I hope everyone's well, I hope your families are well. I thought I'd just get in touch again with another video, prompted I guess by our investment committee meeting late last week, Thursday of last week. We've spent the week since then sort of digesting the information and considering what it might mean for portfolio changes going into the future, and I'll make separate contact about that when we decide on what changes exactly we'll bring in, so particularly for those people with those managed accounts, and we'll incorporate those things as we meet, but I'll let you know about that. But I thought it was good for everybody anyway, hopefully, those who are interested, to just get the latest update on what we're thinking about the economy, geopolitics, the financial markets and so on. Things are changing pretty rapidly as usual. They change and they stay the same in a lot of ways too, of course. So I'll start off with the usual disclaimer about this being a general information session rather than specifically applying to any one person, so or your circumstances without having analysed them. So take it that way, please, of course. And if you have any queries personally about your own situation, of course, just let me know. The investment markets have been going along really quite strongly over the past 12 months particularly, and extend that back for the two years before that even. We're seeing strong averages when we're doing reviews with people for annual performance over the past 3 years at least. And the last year's been especially pleasing, I guess, considering that 3 months was really taken out of play with that V shape that happened from mid-February to April, at the time of the tariff announcements and whatnot, where the markets reacted and then took some time to come back. So that's pleasing. When the markets now are trading at sort of pretty much all-time highs, a little bit of a wobble the last couple of days, but at basically all-time highs. So when that happens, of course, it leads to speculation, and then particularly in the media about, oh well, there's going to be a crash. There's there's plenty of reasons for the markets to drop off, and as is typically the case, I guess, it's not hard and fast one way or the other in our view. There's competing features and factors at work. On the negative side of things, impacting the investment markets that we see are these aggressive trade policies. Obviously, that's the biggest factor, the biggest risk, the biggest unknown at the moment. So there's always that until that sort of settles down and becomes more normalised, I guess. There's a chance of the US economy dramatically suffering as a result too. So again, how high a probability we put on that's arguable, but that's one of the negatives that could be a downside for share markets. There's also the potential for that, as things recover, as economies recover, an uneven recovery across the globe, different sectors, and that desynchronization, if you like, say, a bit of a risk factor, because it sort of creates this more complicated and volatile landscape. So those things are sort of the downside. We also identify plenty of reasons to be positive and to think, well, just because markets are high doesn't mean they crash off. So the positives are things like the global monetary policies. All the central banks around the world are easing off, dropping interest rates, and that's helpful for investment markets. There's good earnings growth momentum. A good example of that is all these big super companies, and just even the bigger, more solid blue chip companies in most of the economies are have got good growth potential. They're holding cash, and a very popular way to deploy that cash in recent times and still is to do share buybacks. So that's another way, of course, of propping up, if you like, share prices. There's also a lot of fiscal or monetary stimulation in the pipelines around the world. So governments are pumping money into things like defence spending, of course, security, infrastructure, those things. So a good example of that is that Germany's announced that 1.4 trillion euro budget to be spent over the next 10 years on defence and security and infrastructure projects. So those kinds of things also help support an economy and financial markets. The trade talks seem to be calming down a little as time goes by, and the behaviours, I guess, are a little more predictable. And there's also these enduring investment themes that'll happen regardless of, not all sectors are affected by tariffs, for example. So AI and some of these themes, energy transition, those kinds of themes are quite resistant to outside influence, and they'll move along as it is, and that provides support too. So balance all of that up, and we end up in that falling on the optimistic side of halfway, and that, I guess, fuels or supports our overall view. Do you remember in earlier videos we talk about these economic scenarios, and at the minute there are 3 of them. We have at 60% likelihood that middle position, if you like. It's an optimistic position. It's that the muddling along position, we've called it in previous videos, and that's where there's still economic growth, but it is slowing a bit. There's a minor possibility of technical recession in the USA. It can happen. The tariffs remain at that base level of 10 to 15%, and they sort of get a bit more normalised. There'll be inflation increasing as a result, but that takes time to work through a system anyway. And even in that scenario, we don't think there's a big inflation risk here in Australia. The central banks in decrease rates, as I said a few minutes ago. So that's kind of the scenario where that we think puts us in that middle spot, where and substantially in that middle spot. Like I said, 60% likelihood, we reckon, of that happening. At the other end of the scale, on the negative, is a higher probability of pretty deep or bad recessions. We think we've moved along from that now, and that's far less likely, and we've shifted that down even to just a 10% likelihood, we think. And then on the other end of the scale, the more optimistic one is that sort of really positive scenario where earnings really takes a jump up, and tariffs are sort of wound back a bit, and like I said, it's sort of all the clouds clear, and that we still have it about 30% likely. So I guess you could say in another way that's a 90% more optimistic outcome, we think, but far more in the middle of that range than there being anything disastrous awaiting us. So things change, things move along, and there are competing factors, as I've said. So we'll continue to monitor that as we go. That's enough probably for one video, just to keep in touch. Nearly 8 minutes. So the last thing I'll end with too is that our friends, our asset consultants at Quilla Consulting have helped us put together a bit of a status report on the US and where that sits now, and after a frenetic beginning to the term of the current administration, where things might sit, and maybe some expectations looking ahead. It's very easy to get emotive and wound up about it all, but like I said, I'll send that out. I think at this stage I'll send that out as an attachment to an email, so that you can read it and digest it, if you're interested, of course. If hopefully it's of interest to some of you. Anyway, I hope everyone's well. It's good to keep in touch. You're always welcome to call, of course. And other than that, take care, and we'll talk soon. Bye bye.